Hello and welcome. This video is about the role of gold in your investment portfolio. If you're thinking about investing in gold for the first time or increasing the allocation of your portfolio to gold, then there's three crucial questions to work through. First, is there going to be enough long-term enduring demand for gold and sufficiently restricted supply to put long-term upward pressure under the price of gold? You don't want to be buying into a bubble. And second, are you buying gold as a hedge against a specific risk? Is gold going to go into the defensive part of your portfolio? Alternatively, are you buying gold as an investment theme? Is it going to go into the growth part of your investment portfolio? And third, how are you going to implement your investment in gold? Are you going to buy an ETF of the shares of gold miners? Or instead, are you going to buy an ETF that holds physical gold? Or are you going to buy physical gold yourself in the form of bars and coins and hold that? Those three crucial questions about supply versus demand, about defensive versus growth, and about how to implement are what I work through in this video. I'm Sam Wylie. I'm an academic, an educator, and an investment strategy consultant to wealthy families and family offices. You probably know that already, so let's get into it. Here we are. If you have any comments or questions, then please email me at my company or at the Melbourne Business School. So it'll help if we talk about the history of gold prices to get started here, just for a couple of minutes. And let's start with the period in which gold was fixed. You can see here that from the beginning of the Republic through to the Great Depression, US households could convert $20.67 into an ounce of gold. That was suspended during the Great Depression by President Roosevelt, who also forced US households to sell their gold to the Treasury to convert their gold into dollars. And then when convertibility was brought back, it was only for central banks around the world, and it was at $35 for an ounce of gold. By 1971, so much gold was flowing out of the US Treasury, central banks around the world were converting their dollars into gold at such a rate that President Nixon took the US dollar off the gold standard. And then in the following year, after gold had been floated, it almost doubled in price. So $35 in the fixed era, and since then, it's grown to over $5,000 here at the time of making of this video. Now, it's more helpful if we look at the log of the gold price here on the y-axis. That's what we've got here, where the price of gold is going up by a factor of 10 every time we jump up one of these bars. And this is more helpful because it really brings out the surges in the gold price. Here, after the floating of gold, it surged 5x, 5 times in price. And then during the oil shocks in the late 1970s, it surged another 5x. Here at the beginning of this century, it surged by 7x over a prolonged period of time. And now we're into a 2.5x surge. Now, this gives comfort to gold bulls because they look at this 2.5 and they think, well, that's not 7 or 5. This might have a long way to go to reach these levels of historical surges in price. Now, I also want to look at the relationship between inflation and gold. And for that purpose, we're going to look at the real price of gold. We've taken the log off from the y-axis here. And this is showing gold in today's dollars to take out inflation. And we can divide it up into different periods of rising and falling inflation. So in the 1970s, rapidly rising inflation and the price of gold going up. And then in the 80s and 90s and all the way up to the GFC, falling inflation and the price of gold going down. And then the GFC was its own thing, was mostly a credit crisis. This part here was a sovereign debt crisis where Greece nearly went out of the Eurozone. But then after the GFC and before COVID, we had a period of falling inflation and the gold price was relatively flat. Then COVID was its own thing, and now we're in a period of rising expected inflation. And again, the gold price is surging. So rising inflation, rising gold, falling inflation, falling gold, falling inflation, flat gold, rising inflation expectations, and rising gold. Now, the reason I emphasize this is because it's very common for people to say that gold is not a hedge for inflation, that there's no correlation between the price of gold and inflation. And the reason they come to that conclusion is to publish their research, they need to divide time up into relatively short periods of time. into weeks or months or quarters or even years. So they've got plenty of data points so they can calculate a correlation. And when you do that, you don't find a strong correlation between gold, the gold price, and inflation. But when you look at the long periods of time, when we just divide history up into the periods of rising inflation and falling inflation, then you see that the gold price is correlated with rising inflation and with falling inflation over the longest sweep of time. That doesn't help to publish papers, but you can just see it in the data. That's the way that investors should think about it. Over very long periods of time, gold is a hedge against rising inflation. We're going to want to answer our three questions. The first of which is there going to be enough long-term demand, a sufficiently restricted long-term supply to ensure that there's upward pressure under the price of gold going forward? We don't want to be buying into a bubble. So we're going to look at these sources of demand going forward, and we're going to have a look at supply expansion as well. To take us into that, let's look at the total stock of gold ever mined. And we can see that that's 216,000 tonnes. Almost all the gold ever mined is still with us. And 100,000 tonnes is in jewelry. 50,000 tonnes is in bars and coins owned by investors outside of central banks. 40,000 tonnes in central banks. And then 33,000 tonnes other, in ornaments of monuments and industrial processes and the like. Now, how much gold is there still to be mined? Well, at current prices, proven reserves that will get mined, 55,000 tonnes, not a very large part of the existing stock. There's more at lower grades that could be mined if prices are high enough. And since prices have surged up, this figure might be higher. But again, not huge compared to the amount that has been mined. Now let's just turn back to total demand. And here we can see that total demand went through 5,000 tonnes for the first time last year. It wasn't a very large increase in total demand. And here we're looking at the different components of that 5,000 tonnes: jewelry fabrication, technology, bar and coin for investors, purchasers, and then gold going into central banks. Let's look at each of these parts separately. We can see a big surge in central bank demand for gold after February 2022, when Russia invaded Ukraine. And we'll talk about that in just a moment. A big increase in the demand from investors in bar and coin and ETFs as well. And of course, something has to give, and what's given is jewelry demand. Now we can see that total supply hasn't increased very much. Mine production is not much over the last year. Recycling of gold is not much higher. But when we come down here to demand, there's something very interesting, and that is that investment demand is way up, 1,000 tonnes over the last year. And that is 180 tonnes into total bar and coin demand, and about 800 tonnes into ETFs. And the difference between these two is interesting as well, because there's a regional component to this. Most of this bar and coin demand is this increase in bar and coin demand is in China and India and the Middle East, where more gold is purchased over the counter. And here in the ETFs, it's more in the US, the UK, and European ETFs. You can see that here. So bar and coin demand. So we've got India, China, the Middle East forming most of that, and it's relatively stable. Like it jumped up 180 tonnes as we saw, but it's relatively stable over time. This total investment demand, India, China, the Middle East, etc. When we come down here to ETFs, we can see that this is much less stable, that there's been a big surge in ETFs, and this is mostly in the US, the UK, and in Europe. A big surge in the demand for investment gold through ETFs. Now, investors need to be aware of that volatility of that demand. It surged up last year, but before that, it was much lower. Sometimes it goes negative. Now, I'm expecting that demand into ETFs in the US and Europe is going to increase and not decrease, but it is very volatile. Investors need to be aware of that. You can see it here. Now let's look at these different drivers of the demand for gold into the long term and compare their relative scales. Let's start with central bank demand. You can see the central bank demand is relatively stable, but it jumped up after the invasion of Ukraine by Russia in February 2022. And what happened there was that 300 billion of Russia's 600 billion in foreign reserves was frozen, mostly by the European Union. But Russia and other central banks concluded that their foreign reserves weren't safe if they were held in US dollars and other foreign currencies in Western banks or even in Western treasury bonds. And so there was a surge in the buying of gold by central banks. And we can see how high this has gone. Now, if we just take this curve and zoom out, this is that curve here. We zoomed out to see that the proportion of total central bank reserves around the world that were held in gold used to be a lot higher. And it's quite possible that it goes back to relatively high levels up here because of that concern about the security of foreign reserves that can be controlled by the United States and Europe. And there's $18 trillion of foreign reserves in central banks other than the US. The US has a reserve currency, $18 trillion, and a bigger proportion of that could easily go into gold. So I'm expecting this to hold up, this central bank demand, well into the long term. What about the US Treasury debt bomb, and what do I mean by that? Well, here we have US federal debt as a proportion of GDP. And we can see that the last time that the US had an administration which had a really responsible attitude to the amount of federal debt was in the Clinton administration. In the GFC, total federal debt surged, and there was no real attempt to bring this back to a more responsible level, such as there was in other periods where the amount of federal debt surged, like in the Second World War. And then it surged again in COVID. Some of this got inflated away because the big burst of inflation in COVID increased nominal GDP, but it didn't increase the level of federal debt. And it's also true that some of this debt is the US owing money to itself, but nonetheless, the part that's not owed to itself is still over 100% of GDP and going to 200% of GDP by 2055. Now here we can see US federal deficits as a percentage of GDP, which are obviously adding to US federal debt as a percentage of GDP. And the striking thing here is not so much how large these deficits were in the GFC or in COVID, but how they're growing in this secular way, even though there's good growth in the United States. This has never happened before. It's never been the case in the United States that during a period of relatively strong growth, there's been these huge deficits here. And what it represents is a loss of political will and the Democrats and Republicans abandoning fiscal restraint. That's what we can expect going forward, that we're not going to see a disciplined approach to managing and controlling the growth of foreign debt by increasing taxes and cutting spending. We're not going to see that. Both parties have essentially abandoned that. There is a debt bomb ticking in the United States. And when that bomb goes off, it's going to be very difficult. It's going to be a financial crisis. And it's going to affect investments in the United States of virtually every kind. Look, when there's a financial crisis, almost any kind of crisis, then people rush to buy US dollars and to buy US treasuries. But if US treasuries are the problem, then they can't be the solution. And so people are going to rush out of those things, including the US dollar, probably out of US equities as well, if there's a financial crisis. Now, I'm not saying that the US won't get through that financial crisis. I think they will, but it's going to take a crisis to galvanize the political will to increase taxes and to cut spending. Now, could the bomb be diffused? Could it be that the political will come about without a crisis? Well, that's not impossible. It's also true that the increase in productivity with AI might grow the US economy at a sufficient rate that the GDP grows faster than the level of debt. Now, I think that would be a plausible scenario if debt was growing at 3.5%, 4.5%, 5% per year. But debt is growing at 6, 7, 8% per year. So I don't think that is a plausible scenario. I think there is going to be a debt crisis in the United States. It might be quite a way off, but investors who are heavily invested in US equities, which should be most investors, really need to think that through and think about whether gold is a good hedge for that. As well as the problem of the ticking debt bomb, there's also the danger of inflation, that the way the US chooses to control its debt is not to increase taxes and cut spending, but to run the economy hot. and to inflate the debt away, essentially. And that's a real danger. And people who are investing in gold are thinking of both of these things, using gold to hedge against the ticking debt bomb and a financial crisis, and using gold to hedge against future potential inflation in the US. Now, there's a way for us to see how long-term these concerns are. And we can see that in the Treasury bond market. So what we can see here is the required yield on 5-year, 10-year, 30-year government bonds. This is the return that investors are demanding to hold these bonds to maturity. Now, those required yields have got these components. So investors need compensation for expected inflation, which will decrease the real spending power of the money that they receive from these bonds. They need the time value of money. Someone else is using their money and they need to be compensated for that in real terms above inflation. They need compensation for the risk that the value of the bond will go down while they're holding it. Now, I know that we can decompose yields into more components than this, and especially we could include liquidity in this. But this three-way decomposition is perfectly valid here. Now, we can see that the yield curve has steepened, that the required return on 5-year bonds has gone down and on 30-year bonds has gone up. But there's something else we can see, and that is if we look at US inflation-protected bonds, these TIPS, Treasury inflation-protected securities, the TIP bonds, then there's no inflation component here. The yield is above and beyond inflation. So these TIPS, these inflation-protected bonds, are, as the name suggests, protected against inflation. The principal of the bond, the amount of money that investors get back at the end of the bond, goes up with inflation, and the coupons go up with inflation as well. So they're completely protected from inflation. And so these yields represent these things, the time value of money, and especially the price risk premium. And you can see how much this has widened just in the last 12 months, that investors are less concerned about what's going to happen in the next 5 years and much more concerned relative to 5 years about what's going to happen in the future, 20 years or further out. And this widening of the required yield on these bonds after we take out inflation is an expression of the concern that investors have that the value of their bond will fall because a debt crisis comes along and investors abandon the holding of US bonds or sell down US bonds as a result of a crisis because there's just too much government debt. And it's not about inflation. This is after inflation has been taken out. It's just about the volume of debt. Okay, we were looking at inflationary pressure, and we were thinking about whether the US might choose to inflate its debt away, and that's a real danger. But there's more going on than that. And we can see that here in a chart of US inflation. And an important thing here is just how much deflationary pressure, how much downward pressure on inflation there was between the GFC and COVID. So you might say that, look, inflation's been quite low in the US for a long time. That's absolutely true. But when we look at inflation here and bring in interest rates in the US, the Fed funds rate here in the US, the benchmark rate in the US, we can see that here, even the deflationary crisis was so large between the GFC and COVID that even after the cutting of interest rates to zero and 3 big rounds of quantitative easing, the Fed couldn't stimulate inflation, couldn't get inflation above this 1 to 2%. They wanted up here, but they couldn't get it up here. And even after very radical measures, and it's because deflationary pressure was immense in this period, driven by globalization and tech advances and demographics and wealth concentration. Now, an open question that no one knows the answer to is, do we go back to this in the post-COVID era? I mean, inflation hasn't headed down there yet. Do we go back to this, or do we go into a more inflationary period as we go forward? Now, a lot of people are looking at this and thinking, we're going to have a more inflationary period. We're not going back to the pre-COVID period. We're going back to a more highly inflationary period for a variety of factors, and we'll talk about this in another video. But people who think that are looking at gold and thinking gold looks attractive as a long-term hedge against inflation, and driven by factors that are not really related to the total amount of US debt. So these are separate things and reasons that investors are interested in gold. I'm not so convinced about that inflationary argument. I think that we are heading back to powerful deflationary forces eventually. Inflation will stay up, but then it'll head back, because those forces that drove the deflationary period between the GFC and COVID, they haven't gone away. But anyway, let's make that another video. Now, there's other factors. There's the fear of political turmoil, and that has different drivers. AI, which we can see here, these are large language models, and political uncertainty and geopolitical turmoil. So just that, that the center is hollowing out in the West. We can see in France, for instance, it's unable to really properly form a government. And in the United Kingdom, you have the rise of UKIP, and everywhere in the West, there is a movement away from the center of politics. That's what I mean by political concern, that process might accelerate. And of course, there's geopolitical concerns as well, especially the tension between the US and China. But here I'm sort of focusing on this AI concern and just how disruptive artificial intelligence is likely to be. This is going to cause long-term demand for gold as a hedging instrument. Here it's an opportunity to look at US households and their demand for gold. If we look at the total wealth of US households, $185 trillion, that's quite a lot of money. Then US households' allocation to gold is only 0.2% of that wealth. And by Goldman Sachs's analysis, if that 0.2% increases by 1 basis point, a percent of a percent, to 0.21%, it implies a 1.4% increase in the gold price. Now, all of the uncertainties we've been talking about, I think, are really likely to drive up US households' demand for gold. And that could have a really profound effect on the gold price. What about cultural demand? And here we're heading away from Europe and the United States, and especially to China and India and the Middle East. This blue part here, this is long-term enduring cultural demand. And as the wealth of China and India grows, as the middle class expands in China and India, this is going to grow. This is enduring demand for gold, driven by cultural effects. So what have we got in terms of long-term drivers of demand? I've got central bank demand enduring, as there's a movement away from currencies to gold in the $18 trillion of reserves in central banks. I think that'll endure. The US Treasury debt bomb, I think, will get worse, and the concern about it will get greater and greater, and demand for gold to hedge against that will get greater. I'm not convinced about inflationary pressure. I think we will head back into a deflationary world, as I said before. The fear of political turmoil, I think that as AI really emerges more and more strongly, this could get very large. And then cultural demand is enduring. Enduring, growing through time. I look at those factors and I see plenty of long-term demand for gold. I think gold is headed up. Mostly I like gold for hedging, but I think those demand factors are really very significant. Okay, what about supply? Well, here we have a graph of gold production going up to 3,500 tons, as we saw before, and price. Here, this price is the green line, and this is in today's dollars. We saw this graph before. Now, what's the relationship between price and production? Well, it's a lagged one. So we can see here the price of gold surging after it was floated, and then in the oil shocks and the inflationary spike in the 1970s. And there was a lagged response in the production of gold. It just takes time to get gold mining production going, to get approvals and to build the mines and the like. And then when the gold price fell back, that increase in production plateaued. Another big surge in the gold price in the first decade of this century was met by a big increase in production. Here, a lagged increase in production. And when the gold price fell back, then there was an ending of that increase in production. And what have we got now? We've got a big increase in the gold price at the moment. And what should we expect? We should expect a lagged increase in the price of gold here. That's what we should expect. But the demand for gold is very large. And the ability to increase the supply of gold doesn't seem to match that. Here we can see different countries producing gold. You know, countries just run out of gold. Look at South Africa here. Obviously, there's been some political changes in South Africa, but resources simply get mined out. So what should we conclude? That the drivers of increased demand in the long term are very large. And there will be increased supply. We don't know how much. That's hard to predict, but it doesn't appear that it's going to match the increase in demand. So I'm expecting long-term upward pressure on the gold price. Let me take a minute before we go on to tell you about my 10-week Finance Education for Investors course. The course is organized around 10 weekly modules of 2 hours of video. It starts on the 7th of May, but you can enroll in the course and start the content today because it's 100% online on demand. From the 7th of May, every Thursday evening at 7 p.m. Eastern Standard Time, there's a live session to discuss that week's module and to answer your questions. The course is for everyone. It starts at the beginning and then goes quickly, but there's plenty of supplementary materials for people who want to go deeper on any topic. The course gives you empowerment in your investing and gets you to much better outcomes. It gives you an investment process of setting goals, making the choices you need to make to reach those goals, and then implementing those choices. It gives you all the knowledge that you need about investing in property, shares, bonds, private equity, venture capital, superannuation, family trusts, borrowing to invest, negative gearing, insurance, financial advice, everything. And it's highly structured. It takes you through a 10-step guided self-examination week by week of your investing to work out what's working for you and to fix what isn't working. It's got terrific materials that are very high quality, videos, calculators, 300 pages of notes, a 10-step workbook for this 10-step guided self-examination. And it's all organized around case studies to make it highly practical and to make it warmer and more interesting to follow. It follows the stories of narrative characters throughout the whole course in these case studies. And then there's one-on-one discussions with me. So go to windlestone.com to enroll or to get more information. You can see a lot of information about the course, including watching some of the videos here. Thousands of people have taken the course and got tremendous value from it. You'll love it too. So let's look at our next question. So what role is gold going to play in your portfolio? Is it going to play a hedging role and be part of your defensive assets, or is it going to play an investment theme role and be part of your growth assets? I can always tell whether someone's buying gold as a hedger or whether they're buying into an investment theme for a growth asset in terms of the language that they use. They'll say something like, oh, that horse is bolted, or that gold has a long way to go, as opposed to a hedger will say something like, gold will keep its value when my other assets fall in a crisis. This is a different way of thinking about the problem and a different positioning in your portfolio. So speculator is thinking in terms of growth assets versus defensive assets, the part of the portfolio. This is an investment theme versus a risk to offset. But here we are thinking about market timing and whether we can time the market, get in, ride the investment theme up, and then get out by timing the market. You shouldn't overestimate your ability to do that. Here we're thinking about investment correlation. Is there a negative correlation between the price of gold and the thing that we're trying to hedge? Is there a negative correlation between inflation and gold? A negative correlation between political uncertainty or the debt bomb in the United States and the price of gold? That's what we're trying to predict or understand, as opposed to market timing. Here we're thinking about gold as an investment theme. And there's lots of different potential investment themes. There's a lot of themes to do with AI, to do with decarbonisation, to do with the aging of the population, to do with urbanisation, etc. So there's many different themes to invest into. And that's why, you know, in thinking about gold as an investment theme, I think about it as a smaller part of total allocation, total strategic asset allocation. Now, when we think about gold as hedging, then we just don't have that many hedging instruments that we could use. In many ways, gold is unique as a long-term hedging instrument. If you have a big exposure, especially to US shares, then I'm thinking about gold as having a more significant part in the portfolio. And that we can see here. Hedging the US debt bond. Investors who have big allocations to US equities, and there's many good reasons for doing that, need to take this seriously. At some stage, there's going to be a financial crisis associated with US debt, and gold is a hedge for that. Hedging a large allocation to US shares against a debt-induced financial crisis. Gold's going to work for that. That brings us to the third question. How are you going to implement your investment in gold? So are you going to buy an ETF of gold miners, the shares of gold miners? Are you going to buy an ETF that holds physical gold, or some combination of those two ETFs? Are you going to hold physical gold yourself? I'm not a big fan of that. I think the ETFs are really the main options. Gold miners, gold physical. So the biggest ETF in the world of gold miner shares is VanEck GDX. You can see that's up 132% over the last year, from 41.96 to 97.39. The biggest ETF in the world for holding physical gold is the Spider Gold Trust. And you can see that's up less. That's up only 69.7% rather than 132%. And we want to understand, as we look here at the relative merits of a gold mining share ETF versus a physical gold ETF, why this has been so much larger in a rising market. It's going to be a lot more going down, pointing in the other direction in a falling market. But we want to understand that and the relative merits of these two. So gold miner ETF versus a physical gold ETF. They both have exposure to gold, of course, but a gold mining ETF has other exposures. It's going to have exposures to global currencies because it's going to be GDX invests in gold miners around the world. So it's going to have exposure to the Aussie dollar, to the Canadian dollar, to South African rand, to other currencies. So it's not just USD exposure. It also has exposure to the local markets on which those gold mining shares are listed. So as those markets go up and down for factors that have got nothing to do with gold, they will move the value of those shares, those gold miner shares, up and down. You know, they have beta. They have exposure to the whole of that market. And then there's the execution of the leadership team of those different gold mining companies. The leadership team has to dig up the gold at the lowest cost possible, has to find new gold. So when you buy the shares of gold miners, you are buying into the ability of the leadership of that company to execute on their strategy. So you have several risks here in the gold miner ETF that you don't have over here. But that doesn't really explain why the gold miner ETFs have gone up so much more than the physical gold ETFs in the last year. That's due to other factors, first of which is operational leverage. So, you know, you can see it's kind of obvious what's going on here. If we have $100 of revenue in our gold mining company and the price of gold goes up by 20%, then our revenue is going to go up 20%, but our costs aren't going to change that much. Now, over time, the cost might increase as there's more competition for the resources that go into gold mining, as gold mining expands. But at least in the short run, gross margin is just going to expand with the increase in price. So 20% increase in price, 67% increase in gross margin. And this is an operational factor. There's operational leverage. Now, there's something else that is more subtle, and that's the options to mine high-cost grades. And let me show you what that is. This is really not very well understood. Let's imagine that we have a gold miner who has an option to mine gold at a cost of $4,500 per ounce. They've got low-grade reserves, which will cost $4,500 to dig up and process and sell. Then that represents a real option. It's not a financial option. It's an option over real things, those real reserves. So it's a real option to mine the gold. And this is like the strike price of the option. Now, if the price of gold is down here, how much is the option worth? Well, it's worth almost nothing. The option to mine gold in our mine at $4,500, because the price of gold has to get up here before we're going to be in the money, and we would want to do it. And the probability of getting into the money anytime soon is very low. So the value of our real option to mine gold at 4,500 to exploit those resources, those low-grade resources, is very low. But as the price of gold moves up, the likelihood that we will be in the money at some stage goes up. And the value of our option doesn't go up. You know, when the price of gold doubles, the value of our option doesn't double. It goes up exponentially. Now we've got a much bigger probability. And that gets factored into the price of the gold miners' shares. And then eventually we're in the money. And we have the value here of the option to mine the gold is not just the $500 in margin that we can make here. It is that the price of gold might go even higher. And then, of course, as the price of gold goes up, this goes up exponentially from here. These real options that exist in miners of every kind, but especially at the moment in gold miners, are really important. And people don't understand those options very well, and the amount of leverage that it puts into gold miners on the way up and on the way down. So if the gold price falls, it means the GDX will fall more than the Spider Trust. Just as in the last year, as the gold price has gone up, operational leverage plus the value of real options has really driven the GDX up. So, you know, it makes those things, operational leverage and the embedded real options, mean that ETFs of gold miners like GDX are really more suited to people investing into the theme of gold, as opposed to hedges. You know, if you're a hedger, you don't want that kind of volatility. There, the physical ETF, the physical gold ETF, is going to suit you better. Operational leverage and real options are really what's driving that big increase in GDX over the Spider physical gold ETF over the last year. This is higher risk and higher return. And down here, this is going to be more suited to hedges in the long run. GDX moving up a lot in the last year, but if the gold price goes down, this will be way below that. What about our third option of holding physical gold directly in bars or coins? Look, if you're going to put a large part of your wealth into holding bars or coins directly, then the first thing you need to do is to bury a shipping container in your backyard. Get in a bit of doomsday prepping if you're going to buy a lot of physical gold. You can tell from that joke that I don't think it's a very good idea to buy physical gold. Look, it's the round trip cost of buying and selling physical gold is large. It's got a high transaction cost. It's not secure and it's not easy. So you're much better off in ETFs. So let's summarize what we've talked about. Gold in your portfolio, strong demand and supply that's not going to grow as quickly as demand going forward. You know, I like the price of gold going forward. Is gold a growth asset or a defensive asset in your portfolio? You're buying into a theme, or are you using it to hedge a specific risk? You've got to be very clear on this. A lot of investors are not very clear on this. What is the role of gold? Now, you won't make good decisions about how to use it in your investment strategy unless you're very clear on what the purpose is. I think that the best role for gold is as a defensive asset against large US share allocation, where a significant danger here is the US debt bomb. And finally, we talked about gold mining shares versus physical. This is better suited to people who are using gold as a hedge, and this is better suited to people who are buying into the investment theme. So I hope you found this useful and that you'll watch the videos that will follow this. And don't forget about my investment course, which is coming up in May.